So, hello and welcome to this week's instalment of Nucleus Investment Insights. And today we're looking at somewhat of a perennial topic at Nucleus Wealth, and I guess one that also deserves a little bit of a review. Last time we looked at this, I think it was about 12 odd months ago, maybe a touch less, and we've called it MegaTrends. So we're going to be diving into some of the key, what we think are megatrends that are going to be affecting investment and things to think about going forward. I'm joined, as always, by our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Jim.
And with no further ado, let's jump into it. So perhaps we better start by looking at long-term trends and giving us a little bit of an overview of exactly what a long-term trend is.
Yeah, sure. So, look, I think the key thing for me is, and why we like to sort of pop this up every sort of 9 to 12 months type thing, is because there are some very, very big trends affecting investments that last 20, 30 years. And none of them are like I have to rush straight out of the house right now and buy something or sell something because of these trends. But it is important to keep coming back and just remind yourself of where these big trends are sitting, because they do colour the whole investment perspective. And some of those in particular have made there've been some significant tailwinds for markets and for equities over a certain period of time, and we need to recognise that. Let's say bond yields, for example, the bond markets had a great run as interest rates sort of fell from 20% down to effectively zero in most markets. That's obviously not going to keep going. We're not going to negative 20% interest rates, and so we need to recognise that the trends we've seen over the last 30 odd years, need to be reviewed.
Absolutely.
So with that in mind, I guess I've got a chart up which is basically just sort of showing some of these longer term trends. It's just an indication of the types of trends, and the fact is that they are going to get knocked off by, so you might have this big demographic trend which is driving your growth higher than it would have ordinarily been, but it'll get knocked off by recessions or wars or other economic events,
government policy perhaps,
government policies for short periods of time, and so what you'll see is the trend will sort of be there over that longer period, but it'll disappear for a little bit, and it's not until you come out the other end of the recession where it comes out as higher or lower, or you get to see sort of where the trend's going. Okay, sure. So so with that in mind, it is important to keep in mind you're not going to you can lose money for years betting solely on these trends, even though you might make it over the longer term. So with that in mind, we'll sort of jump through to the first trend.
Yeah, all right, let's kick it off. So we've got trend number one today, which is rising inequality. We've got a chart up here, and for those that are listening in, head over to the show notes, and there'll be a PDF link there for the show notes of today and the charts that we put up today. But we've got a share of US total income received by the richest 1% of the population. So this is certainly a topic or a trend that's getting more and more publicity, I guess, and more noticed, I guess, particularly in the US, with the rise of the 1%ers.
Yeah, absolutely. Lots of airplay for this. Look, this has been a core one for me for a long time now, and this sort of comes back to the secular stagnation. So one of the comments coming out of the financial crisis is that we're in this new normal where the growth rates we've seen before just aren't going to be achieved anymore, and that a lot of central banks in particular, and very much the Australian Central Bank, is sort of confused by this whole everything's going to revert to trend. We're going to keep firing up growth. Growth at the moment is quite low in Australia, and they're having and inflation's low, and they keep forecasting, hey, it's just going to bounce back next year, and it never does. Yeah, sure. And so you need to. One of the things this comes back to for me is this rise in inequality. In that, if I give a rich person another $1,000, they sort of look at the money and, what am I going to do with this? Oh, well, I'll throw it on the pile. I'm effectively going to save it. Yeah, sure. Whereas you give $1,000 to a poor person, generally speaking, there's half a dozen credit cards to. I was going to say they spend $1,500. So Maybe. So the effect on demand or sort of aggregate demand from that is significant. So if you have a certain amount of GDP coming out of a country and you divide it up equally between people, then people will go and then spend that money. If you take it and unequally divide it, so that I give a big chunk of it to one or two people and the rest of it sort of everyone else has to take less, the amount of demand you'll get out of that is less. And that's been a trend very much in place for, we've seen that sort of 50 odd years. One of my personal pet theories is that a lot of this comes from the fall in communism, in particular when communism was a big threat for a lot of countries, and what you saw capitalism had to be muted, and they had to make sure that with all these countries around me, if you're in Europe and you're France or Germany or somewhere like that, you're seeing countries right next to you falling to communism. You have to go, well, I need to make sure I look after the people at the bottom, because if I don't look after the people at the bottom, next thing you know, there's torches and pitchforks and they're installing a communist government in my country. So you needed to have this sort of constrained capitalism where the poorest people actually
got a share.
Yeah, exactly,
right.
and benefited. And then once communism sort of faded as a threat and it's no longer, that didn't work.
We could go into hyper-capitalism.
Exactly. It's like capitalism work. Capitalism's the best ever.
Yep.
We can do as much as we want, and we need more of it.
Yep.
And we need more inequality, which I think was exactly the wrong lesson. The lesson was capitalism did so well for that period because it was constrained capitalism as opposed to, letting people push things to extremes.
So that's fascinating. So I guess, is it going to take a resurgence in communism to quell these 1% problem that we're seeing around the world?
We've certainly seen a resurgence in socialism.
Yep.
I think there's if in the US in particular, to brand yourself a socialist was sort of making yourself unelectable in the US, and we saw very much that politicians from the Democratic side of the scheme turn themselves into, and right around the world, not only in the US, but they turn themselves into these efficient market, and they roll back a lot of protections, and we saw Clinton and Tony Blair in the UK and Hawke and Keating in Australia they rolled back a lot of the protections and helped. A lot of these movements had helped because the pendulum had swung too far the other way into too much protectionism.
Yep.
But then it sort of became, because those were so successful, then the pendulum sort of hit the middle, and then people went, well, because that was successful, we need to keep pushing that pendulum further, and now we're swinging out too far to the other side.
Yeah. Okay.
And so. You are getting the rise now in terms of where I was leading with that is socialism was this dirty word where nobody wanted to be called a socialist, whereas now we have Bernie Sanders standing up and proudly declaring himself as a socialist and not being punished in the polls as anywhere near what it would have been 20, 30 years ago. And
even more locally with what's happening on Saturday, we're seeing some of those themes start to be played out as a as a reason to
absolutely it's a very big thing for the election we've got at the moment. Whether I would classify personally, Shorten's changes as being, a step in the right direction, but certainly that's not a step in the direction back towards a sort of a more equal society. But they're not major changes. They're not revolutionary changes. They're sort of still just chipping away at the edges of the problem.
Right, light as opposed to left, perhaps.
Yeah, and so the question is, do you need to get things so extreme that you do get revolutionary issues? And we've seen in France, the rise of the yellow vest sort of movement, and there's lots of other examples around the world. Initially I had thought when the 1% protests started, I thought this is the start of the whole the unwind, but they went away, and so I guess we're waiting for the next major crisis or things just to get so extreme that you do get a relatively big uprising. And what's ironic about France actually is that France is actually probably one of the places that hasn't got as much of this problem. They do have sort of more equality than other countries. So
Okay, yeah, sure.
But the trend there, so I guess the idea is the more inequality you get, the lower the demand, and so that's a headwind for growth. So most of the growth we've seen over the last 20, 30 years has been despite this rising inequality. So this rising inequality has been sort of pushing back, and but the tailwinds we're about to see in some of these other trends have been more than enough to overcome this rising inequality.
Okay.
Yeah, and the question is where's equality going at the moment? It's despite, as we said, the elections this weekend and what's happening in the US, equality is still moving in the wrong direction from a demand perspective.
Yeah, okay. Yeah, sure. All right, very good. So we'll zoom across to trend number 2. So we've got, this one's called baby boomers, I should start with. And so we've got a series of fairly popular descriptive charts, I guess, that are used to sort of show what they term as, I believe, is it the age bulge or something like that, and the boomer bulge or something has been used to term?
Absolutely. So the demographic trend. So basically, post the Second World War, there was a big growth of babies, and we saw this, and you gradually saw this move throughout the demographics. So at the start, that was a negative because there was a lot more kids out there that people, a lot more. So the workers had to feed and clothe and educate more kids, and then it started to become a positive as those kids started to work, and then you had that 20, 30 years of those kids going from being green workers to more experienced workers and really getting this benefit from them, and now that cohort's starting to retire.
Yep.
And so the next graph is actually probably better. There's sort of this for anyone listening. There's sort of those ones sort of showing the pig and the python type things as it gradually moves through the snake. The one I like better is what they call a dependency ratio. And so what that characterizes is how many workers do you have compared to the number of kids and the number of retired people.
Yep.
And so that one, now this is US data, but the data is pretty similar around the world.
Okay.
From what you see, but it sort of peaked at sort of 85%ish in terms of back in the 60s, and that's saying you had 15 workers for every 85 non-workers, which is kids, people being educated, retirees, and things like that. But the amount of retirees was very small of that proportion, so the amount of kids was particularly high. And keep in mind as well, that was you often had non-working mothers and wives.
Workforce participation was a lot lower back then.
Yeah. Yep. But so we've seen that fell, for 50 odd years, that fell, and now it's just coming to the times where it's starting to rise. You're starting to hit these periods now where demographically these baby boomers are retiring and they're becoming a bigger impost. Birth rates were relatively low for the last sort of 20, 30 years compared to the 20 or 30 years earlier than that.
Yep.
So there's fewer people coming into the workplace to replace these people retiring, and so that is another one that's one that's sort of hitting this, or was roundabout hitting the stage now, or over the last 4 or 5 years and the next 4 or 5 years, where it's hitting the point where it's turning. So it's going from being this great big headwind where more workers, more efficient workers, more experienced workers, and now it's flipping around and now
going the other way.
Fewer workers,
but still alive.
Exactly. So which need to be supported.
Yeah, sure.
So
and I guess obviously this is a growing problem. How does that sort of play out into sort of an investment and a growth sort of side of things? And do you expect it to change, or is there things that we can do to change it?
Yeah, well, I think this is one of those ones where we need to look back at the growth rates from the last 20, 30 years and acknowledge that they included this portion of extra people in the workforce. And so we can't expect that same growth to be going forward.
Okay.
It does mean that the question about if you want to be exposed to children's diapers or adult diapers, you probably go for the adult diapers end in terms of that's one of the statistics from Japan, where Japan sort of has a very low birth rate and very low immigration as well. So they've been through this problem in a shrinking population.
Yep.
That's part of the reason for their stagnation over the last 20 years. But one of the statistics from there that popped out was that at a certain stage they started selling more adult diapers than what they did children's diapers.
Right.
Which is sort of like
and that was the inflection point. That's when you've got a problem.
Exactly. Yeah, I suspect even by the time you reach that stage, you're past. You're well into the problem. But but yeah, it's an anecdotal view of showing that how bad the problem is. And so we can't keep talking about reversion to a mean from a prior time.
Yeah, sure.
And another analogy used by Jeremy Grantham from GMO is saying, you need to recognise you can't be if you're on a stallion and you're going to be whipping it along and growing it at 3.5-4% if that's your sort of target rate.
Yep.
But if you're riding a donkey and you're going to sit there whipping it, maybe you can get it up to that 3.5-4% for short periods of time, but you can't over the longer term.
Not sustainable.
So you need to know if you're riding a donkey, just whipping it, you're going to kill the thing eventually.
Okay, sure.
So it's not a question of,
pressing the accelerator the whole time.
Exactly. And that's where I think there are central banks around the world that are recognising this and speak a lot about it. I think the Australian central bank's been quite behind the curve in terms of their certainly their acknowledgement of the issue, and they have a very much a reversion to mean view of forecasting for the last few years, where everything's it's always going to pop back up to the mean, and the mean's quite high, and they do need to ratchet this back. So that's as we're investing, we just need to
keep mindful of that.
Yeah, temper our growth expectations.
Just quickly, just looking sort of viewing locally. Obviously, we've got probably Japan being the extreme end of one bound. US somewhere in the middle. Where would Australia sit sort of in this? Are we using the US model as a bit of guidance, or are you taking lessons from Japan? Or
Australia's pretty good, mainly because we have a high immigration rate.
Yep.
You do need to question. I think we spoke about last week about saying you need to question your types of immigration, because there's sort of, for my mind, there's three types of it. Where if you've got immigration of lots of relatively young, well-educated,
pre-family,
or at least dynamic in terms of saying moving for economic opportunities to better my life and entrepreneurial and things like that. There's a base of people like that have grown Australia and grown the US and other sort of countries where it's a valuable type of immigration and it's what you want.
Yep.
If you've got the end of it where you're saying, okay, I'm bringing over people who are old and have paid taxes in another country for all their lifetime, and now I'm bringing them here so they can use our medical facilities and then and then pass on. That's obviously less useful.
You're building the wrong end of the bulge, essentially.
Exactly.
Yeah.
And if you're bringing over students though who don't speak the language particularly well and are basically being, you're taking $40,000-$50,000 from these people and shoving them into university courses and they're coming out and driving Ubers at the other end. That's not a useful form of immigration as well. So it's sort of a question about saying.
We know which lever to pull, but we're just going to make sure that the powers that be pull the right lever.
And so I guess where I'm getting to from that is Japan's at one end. China's actually pretty close to the Japanese end.
Is that right?
But their one-child policy was what drove it, and so they're hitting their inflection point about now as well. So they're rolling over from actually probably 2 or 3 years ago. I think they started rolling over from starting to lose workers in terms of lose working age population.
Starting to grey out.
Yes.
So is that an investment note for people and get their pencils out and go long adult diapers in China? Is that a good trade tip?
That's right. There's been a number of people who've commented the pithy comment, but it's China's going to grow old before it'll grow rich. So again, it's that. You look back at the last 20 years and go, look how fast they've grown. Surely they're going to be 3 times the size of America, and they're going to rule the world type stuff. And whereas a demographic sort of says, well, demographically, they're hitting that point now, and
they're on the donkey, not the stallion.
Yeah, exactly.
Sure.
So US and Australia are pretty good. Europe's on the worst side, and Japan and China Japan's the worst. Europe and China are probably in a similar position. But I guess Australia and US, while they're in a relatively good position, they're not. Keep note of the word relative. It's still a worse position than where, in either of them, you take Australia or the US from 20 years ago, demographically, well before you take either of those countries as at today.
Yeah, sure. Okay. All right. Very good. We'll jump into our third one now. Women in the workforce. So I've got a chart up here showing from 1966 up until 2013. And I guess it's participation rate, or just the number of women rising from 14% to sort of plateauing out in the early 50%.
Yeah.
2013.
So this is another trend. 50 odd years of going from the accepted wisdom that women don't work, they stay at home and look after kids and whatever. And then as they move into the workforce, and you get this, certainly a GDP benefit. I mean, there is an issue that
because it's not counted.
Exactly. You're saying, well, if you have two non-working wives and each of them decide to mind each other's kids and charge each other the same amount for them, that's a big boost to GDP with. There's no real effect, there's still two kids being looked after, and so so we do need to recognise that the GDP figures we're looking at and some of the economic growth figures have been juiced by this
by just participating in paid workforce rather than unpaid, essentially.
Yeah, exactly. But it does mean as well that we do get and there's the other big benefit though, obviously, is that there are women who are, I guess, capable of and want to do a lot more in terms of adding value to the economy. I don't want to downplay the benefit of minding children, but I guess it's a lower paid job.
Yeah,
so
you want to be able to go home tonight. So
yeah, that's right. If there's a question about saying if there's a leader of a country who's particularly well suited, or a leader of a company that adds a lot of value to in terms of position, and she can work more, and there's somebody else who's minding her kids for her, then
it's double plus.
That's right. It's more efficient allocation of resources, and so we've seen that for 50 odd years, which is again added to all our growth figures, but very much seems to have capped out. I've got another graph up there just showing slightly different numbers this time, because there's sort of a few different ways of measuring it, but this one's showing a number of different countries, and we can see on this one that Japan's actually started going backwards in terms of that, and the US is sort of capping out as well. And so the question is for so the US and Japan have gone backwards over the last few years. Australia's flattened out. And so the question is, have they actually reached a level where we're starting to go back the other way, because there's women who have now gone, well, economically I'm happy. I actually don't want to work. I'm happy to work 3 days a week or 4 days a week, rather than being having to work. Now, you've got the option. Exactly. Rather than feeling obliged to, I have to be in the workforce. They're starting to step back and say, well, for lifestyle reasons, I'll work less or whatever. Yeah. Okay. Fair enough. That's interesting. So I guess it's in question of saying, will this trend continue? For my part, it's saying I think it looks as if we've reached a point where there's probably not heaps more growth in it, and quite possibly there's a decline as in some countries people feel as if they've reached a level where they'd like to opt to work less. So from an investment point of view, it's a net negative on demand looking forward. Yes, yeah. So now, probably a net negative. It's at best you'd say it's a neutral. If you made the view that no, we've reached the plateau where and now it's going to go sideways from here, then it's neutral. It's gone from being a nice big headwind for 50 years to neutral. But some countries are looking like it's actually going to turn a little bit negative for probably not for long, but there's probably just take the top off the existing part. And as you touched on before, the fact that it's been rising so much in say the last sort of 3 or 4 decades, it's been a positive juice to the numbers, as you say, and so now that juice is starting to come out of the numbers. You just need to bring down your expectations for growth. Okay, fantastic. All right, we'll jump across to trend 4. And that we've called debt. So we've got it here up and away. I might need to just run through this chart here. We've got a spike in public debt that looks like it's sort of tailed off in the last sort of 3 decades, and private debt has resumed its trip to the moon. Yeah. So what I'm comparing is, and this is just very long-term figures for Australia, is public debt. So debt from the government, which rose quite quickly for the early part of the 1900s and sort of peaked out at sort of 150% odd of GDP around about World War II. and then fell quite dramatically since then, and is now at relatively low levels compared to its history. On the flip side, private debt from 1970 has gone ballistic. So well up over 150% of the GDP, and that's just done nothing but grow since the end of that chart that we can see there.
Sure.
So there's questions about why, and one of the answers for my part is that when you have rising inequality but falling interest rates, then you can substitute, and people still want to spend the money. You can substitute
earnings for debt.
For debt. Exactly. You can say, well, Tim, you might have been able to buy a house 50 years ago with using a certain amount of your income and all that. The house price is now 10 times higher, and your income's only gone up, 5 times.
But you need a house.
And you know what? Interest rates are much lower, so I'll actually lend you way more money than what you would have lent.
Sure.
And that helps to smooth over the inequality issues, because when people can't afford to buy the things, they're a lot more upset than when they can afford to buy it. It's just backloaded, and you're paying for it for the next 30 years rather than 10 years or whatever.
Yeah, sure.
So.
Going forward.
Yeah, so going forward, though, there's a limit to how much debt people can take on. So and there's a limit to how low interest rates can go.
Yep.
And we're pretty close to the bottom. I mean, globally, this is not just an Australia-specific one. This is across most advanced economies. We can see exactly the same trend. So from an interest rate perspective, we've pretty much hit the bottom worldwide. Australia's got a few more interest rates cuts to go, but not many. So there's very little we can do in terms of that front.
Yep.
Now, to get that debt either down or so that people can borrow more, you basically need to get their wages up. And that's part of that whole inequality problem, is because not enough demand, wages aren't rising, and so we're sort of caught in this loop that's sort of where the debt was very useful about masking the inequality. And I spoke earlier about how the inequality, all this had been done despite the rising inequality. So for my part, the rise in debt was one of the biggest things that allowed the inequality to keep rising and going on, because people didn't notice as much.
Yep.
I still got to buy my car and my house and all that type of stuff. It was just I had to borrow the money rather than
spot on.
Than saving it 50 years ago.
And that made me happy, so I didn't kick up a stink for a few years.
Exactly. And so now we're starting to hit the stage, and it's probably maybe it happens in the next 2 or 3 years, maybe it happens in the next 15 years. It's not an imminent issue, but it's certainly an issue that's sitting there and could happen at any stage.
Yep.
In terms of the when this turns, and we're starting to see in Australia, the pullback of what people are allowed to borrow in their house, has caused a huge decrease in the number of building approvals, and the question, will that flow into unemployment and other major issues in Australia is quite possible.
Yep.
And so it sort of comes back to that point about you need to recognise that this has happened, and that there's been this huge build-up in debt, and that banks for years and years and years grew their loan books at double-digit rates. And you say, well, how can your bank keep on going at 10% per annum at loan book when people's incomes are growing at 3 and 4%?
Yeah, that's it. And especially if if growing at double-digit rates, then is there anyone actually paying back this debt, or is it just debt and more debt? So. Yeah. A quick one on this one, though. So when we touched on this last week, when we were just sort of discussing what was going on in Australian housing, so there's been a bit of argy-bargy around the 7.25% cap that was the high watermark, I guess, essentially, for serviceability. Not really talking about that, but more just a question that came up in my mind that we didn't get a chance to ask was, do you actually ever see like home loan rates ever getting to 7% again? Like, it's, let's say, our lifetime. We'll use your lifetime, maybe plus 10 for those listening at home for myself.
Oh, look. I mean, I can, but not under current conditions and the way we're pointed at the moment. I guess we need some structural change in the way we're conducting monetary and fiscal policy. So one of the ways to look at this is I'm just trying to remember the guy's name, is from Bridgewater.
Ray Dalio.
Yeah, yep. Ray Dalio. So one of our podcasts. We ran through sort of his longer term views on how how these have been resolved in the past. And so basically, when you have these big rises in debt, there's a few different ways you can get around it. You can debt write-offs and jubilees, and you can have defaults and the lenders have to take it.
Yep.
And inflation is the key one as to, well, if I get some inflation going, then I can inflate away those debts from before, and as long as I get that. So the question is about how to get inflation going, and that's usually the easiest one because it's the
most painless.
Most painless, and people don't really notice it as much.
Yep.
The question is,
unless you're in Venezuela, but anyway,
exactly. Unless you end up at pushing it too far, and so the question is saying, we're in this what he terms as monetary policy 1.0, which is basically we raise rates and we lower rates, and maybe a little bit of macroprudential around the edges, but that's basically all we're doing is raising rates and lowering rates, and it looks, especially as you see that build up in debt over the monetary policy era. So since we started using interest rates, basically what it's shown is that we can lower interest rates, which gets people to go out and borrow more and gets the economy going again, and then we can raise rates, which slows the economy down, and then we can do that up and down, but
just slowly working to zero, though.
Yeah, we've got this drift where the debt's hit this point where you say, well, now it's hit a level where people can't borrow anymore, and so when there are lower interest rates, nobody rushes out to borrow.
Yep.
Or not enough people rush out to borrow, and so we don't get the benefit. So you say you need something else, and usually the other thing would be government fiscal spending. But the next stage, I guess, monetary policy 2.0 was central banks going out and buying other assets.
Yep, sure.
So they've gone out and bought government bonds. In Japan, they're basically buying everything. They're buying exchange traded funds, so effectively buying stocks on the stock market.
Yep.
Trying to get this cash out there and get people, please go out and borrow some money and go and invest. And it's been relatively unsuccessful. Question is, maybe it's been successful at staving off disaster, but it certainly hasn't been successful at creating inflation.
Yeah. Okay.
So now we get to the third issue. The third part is saying, well, how do we actually, what's next? And the next is helicopter drops of money straight to either governments or to people.
Yep.
So whether you're going to be starting, not living wages. What's our
universal
basic income
UBI. Yep.
Or we're basically just giving money to people, or the central banks just starts printing money to give it to the government to get out and spend it.
Okay.
And you start these big sort of government driven projects in terms of just to get that demand back in. Either way, you need to get that inflation going. If you can get inflation going, then you can get back to your 7% interest rate. It's a very long way to answer that question, but under the current, especially Australia's current settings, to me, 7.25% looks, no, we're never going to get there.
Yep.
You need to see fundamental change where governments either need to get out and spend a lot of money, or central banks need to be pushing money, to governments, or pushing it out to the people.
Okay.
To get there.
All right. Yeah. Good answer. All right. Fantastic. Just while we're on this one, one last one.
So it's worth noting that you want to get that inflation is the important part of that inflation is getting wage growth inflation. Getting inflation for the sake of inflation just makes things worse.
Yeah, sure.
So you want the inflation to actually flow through into people's pockets.
And a good example of this might be, say, like energy prices, which have gone up, incredibly against like a lot of other parts of the inflation basket, and yet those profits seem to just wander offshore. And
you'd note that's very much in Australia. In other countries, that's not the case.
Sure.
Depends upon where you look. Like the US have had falling, electricity costs. And largely due to the cheap gas they've got. Yep. Australia's problem, as David Llewellyn-Smith obviously bangs on about non-stop, rightly, is that we're about to be the world's biggest exporter of gas, and we've got the world's most expensive gas.
Yep.
Or close to the world's most expensive gas.
Largest exporter of gas and largest exporter of foreign profits.
Exactly. And so and those companies have got and there's this, the royalty streams are almost nothing. So it's that ironically, the gas price goes up in the world, and it actually makes Australia, which was about to be the world's biggest exporter, it's a bad thing because we don't get any royalties from it because they've all still got these massive losses they still need to work through, and local gas prices go up, and so it's a net negative for the economy.
Horrendous. Okay.
And it is also worth noting, just in terms of debt write-offs and things like that. So you can get these debt forgiveness. There's been a bunch of different scenarios recently that have shown that that's probably not going to happen. You saw in Japan, we had most of the debt was concentrated in companies in the 1990s, and they basically propped up those companies, and they made what they called zombie companies, which sort of sat there and so much debt they can't do anything, but they kept them alive for show purposes, and so the lenders didn't have to take these huge losses.
Right. Yep.
We saw very similar in the US. The housing loans there, where again, it was a question of, well, people who have made the loans to these, they called ninja loans to people with no jobs, no income, and no assets. Should they lose the money, or should we effectively bail them out and keep them going? And the decision was largely made to bail them out. In Europe, Greece sort of hit this stage where, for most independent observers, they look at the amount and go, Greece can never pay this money back. The people that lent the money, the generally German banks and these other guys, should take these big write-downs and get on with their life. And the decision was made, no. Let's just extend and pretend. Pretend they'll pay it back, so that the banks don't have to have the write-downs, and you don't make half the banking system insolvent.
Fall over. Okay.
So it does seem China did a very similar thing in the early 2000s with their housing market. There's just been time and time again where the decision's been made to say, well, if a lot of people have lent money to a particular sector or a particular country, let's just pretend everything's all right, and we'll extend the problem for years, rather than the people that lent the money can take the pain, and then we'll get back on with.
And hopefully magical inflation will make this problem disappear, perhaps in the long run as well.
Yes.
Okay, sure thing. We'll jump across to the next one.
Yeah.
So our final one here is...
second last one,
beg your pardon. Trend number 5, company tax rates. So we've got a chart here from 81 to 2016. We're showing a combined corporate tax rate falling from 52 to 25, so halving.
So globally, company tax rates have halved over the last 50-odd years. So this is a trend which has been, obviously very beneficial for companies. So if we're looking at company profits, my estimate is roughly about a third of company. So if you look at the total increase in company profits over that sort of 30, 40-year period, my estimate is roughly about a third of that increase in profits has come from lower tax rates.
Lower tax rate, okay.
Yeah. Yep. So when you look back at company growth rates and say, what can I expect from my equities holdings, and what can I expect from my, to come about from these? At the moment, you can probably keep expecting this tax rate to go down. The US cut its tax rate, and there's talk about, other countries still looking at lowering. Australia keeps talking about lowering its corporate tax rate.
Yep.
But is this a sustainable, obviously you will hit zero at some stage, and I guess as a tailwind or a headwind, it does seem very much to still be a tailwind for me. Is you still are getting these tax cuts flow through, and you still will see, say from the US, as people restructure their tax
affairs,
their affairs to suit the new regime, you'll see the tax rates get lower again. So you generally see when tax rates get cut and big changes happen, you get this initial burst where it falls, and then you get another bit of a tail over the next few years as people work out, if I set my head office over here and this over there, and shovel things around, I can save myself another 3 or 4% or whatever on the tax. So it is worth noting that whenever we look back as a trend, about a third roughly of the profit gains you've seen for the last 20, 30 years have just been taxes falling.
Socialised loss.
and it does look like that's still going to keep going, but it is one thing you need to keep an eye on for when that trend eventually either ends, and it's probably similar to the inequality bit. When you see that turn, is probably a similar time when you see these tax rates return.
Okay, sure. And you've got the... Oh, this is just running through the... just
The
a
rough
couple of stats.
calculation. Yeah.
Yep, okay.
And the final trend...
And just before we roll into our final trend, I've just got a quick question here as well from James. So with Australia being so technologically challenged at the best of times, do you see us falling by the wayside over the next 2 decades or 10 to 20 years? Given that we haven't really prepared ourselves for the tech revolution that is upcoming. Some would say the tech revolution might be well on its way, but anyway.
Yeah. Oh, look, it's absolutely an issue for Australia. I think there's a huge automation. I guess the ones I'm talking about at the moment are the longer term trends. There's some what I call mid-term trends, which sort of fall more into the into James's question. So technological change has been happening for hundreds of years. So regardless of whether you're moving from bows and arrows to guns or steam engines and things like that,
Industrial Revolution.
Yeah, but it does go through periods where it zips along for a little bit, and then you get some periods of stagnation and zipping along. And we do seem to be hitting this period of automation, where over the next few years, the amount of robotics and amount of automation and all these have hit this stage where they've now got the capability of potentially being driverless, and we've seen a lot of the mines are already pushed to driverless. The question about driverless cars, whether it gets how widespread that is, lots of debate over that. But it's certainly at a stage now where 20 years ago, if you spoke about driverless cars, it was some pipe dream in the future. Right now, we're saying, well, we know it works. It's just a question of getting it efficient enough. And maybe a question about how long that final bit will work. So Australia's position has not been particularly good at all. We had some technologists on a few weeks ago, Matt Barry, to run through some of the issues, but very much it's been the houses and holes economy where we're digging stuff out of the ground and selling it to people and using that to go and sell bigger houses to ourselves. And we do need to get Australia to the point where the average entrepreneur doesn't want to go out and buy a house and do it up and sell to somebody. They actually do want to go out and start a business or start something. So technologically, Australia has all the capability. It's got the educated workforce. It's got a lot of the rule of law. It's got all people who are. The education systems, faults notwithstanding, is generally designed to make people think for themselves, as opposed to other ones which might be very good at getting scores, but are just designed to everyone has to fit into the one mould, and they're generally not very good at innovation. So Australia has all the pieces in play, but the structurally and the outlook for Australians from where do they want to invest and do they want to be technologically diverse, I think still needs to change. And I think a lot of that needs to be a lower Australian dollar. And it's partly that resources curse about when you can go and find something or find a miner and you can see your money go up 10 times or whatever. There's a certain lottery aspect. If that's not available, then you find some of those people who would have been doing that investing are out building new things or creating new things.
Being productive.
Yes, and so for my part, we need to see a lower Aussie dollar before you can really start to see Australia.
So do you think that's a linchpin? I guess going back to the question on automation, because I guess the opportunity lies to either be a country that creates the automation or buys in the automation and plonks it on the ground. And because obviously Australia's not the cheapest place in the world to get land, the second option is probably not as tantalising to reinvigorate a manufacturing base. Would you agree? Like, speaking to the fact we've had a massively declining manufacturing base, if we were going to return to that and automation was going to be the key, surely it would make sense that we actually designed and built the automation rather than just bringing it in. Yeah,
well, absolutely. I mean, Australia was is a leader in a whole bunch of different areas that they've let go. Whether it be solar power. Australia, in terms of driverless technology, Australia has some of the first driverless technology in all the mines, and quite an innovative leader there. But you'd argue we've fallen behind some of the Googles and people like that who are busily turning that into how can we extend that into other things, whereas we're sort of we're still pushing back on that. So I guess. If I was going to pick an area, if I was going to pick a country at the moment, it wouldn't be Australia. But I could easily see maybe 4 or 5 years, you could see enough. If things were put in place, you could get those. You get that turned around.
Yep.
And the other thing to note as well is this whole automation boom is actually going to make inequality worse.
Yep.
Because
the smart people are going to be in charge, and there's going to be no need for
exactly. You put a truck driver out of work, and you put an IT graduate into work. There's chances are you'll be paying that IT graduate in a few years a lot more, and if his job changes or whatever, he can quite often jump into something different. Whereas the truck driver might find that he just doesn't have the skills for anything, and can't go and write the code to run
to finish it off, or to get the job done. Okay, very good. Thanks, James. Thanks for that one. We'll jump across into trend 6. So topical, I guess, in world trade. So
so this one is just showing that sort of over the last. Again, this is a little bit longer, this graph, but it's certainly showing that world trade has dramatically increased over the last sort of 50, 100 years. And so that's been a big tailwind for the world economy.
Yep.
So, generally speaking, it means that if you have two countries producing all the same goods, and you decide to get one country to produce one set of goods and the other country to produce the other, is they both become more efficient in the thing they're specialised, and they can trade, and the whole GDP rises more than it would have otherwise risen.
Yep.
So from an economic standpoint, it's been this great tailwind. Obviously, Trump has got some ideas on what he thinks is fair trade.
Mm-hmm.
I'd actually argue that China has been cheating a lot of the issues, and so he's got some real and valid concerns. But is world trade going to keep increasing? Chances are not. And that's one that's sort of looking again like flipping from being this great tailwind of economies growing much faster because trade was growing much faster to turning the other way, and whether I'm not talking about going back to the depths, but it's certainly not looking like rising, and over the next few years probably will reduce a bit as people reduce their reliance on China as being the manufacturing place for everything.
Yep. Okay, sure thing. Okay, very good. So we'll bring it together. So we'll talk a quick run through of the headwinds and tailwinds as we've spoken about now.
Yeah, so 40 to 50 years. So the last 40 to 50 years, we've basically had 5 tailwinds and 1 headwind. So one headwind is rising inequality.
Mm-hmm.
We've had two big demographic trends working in our favour, which is the baby boomers and the female participation.
Yep.
There's been this huge rise in debt that's sort of driven things along, and we've had our sorry.
That it? Apologies for that.
Yeah, sorry about that. And then we've had our corporate taxes falling, and what was our last one? What was this?
Oh, world trade.
World trade.
Yep.
And then, sorry. Okay, so now they're changing though. So let's move now onto 3 different headwinds. So now we're talking about the baby boomers are no longer a tailwind; they're now turning into a headwind.
Mm-hmm.
Inequality is still a headwind, so that hasn't changed, and world trade is become a headwind. In terms of neutral, female participation is at best neutral. Maybe it's actually even a little bit negative in some areas.
Okay.
On the tailwinds, look, debt. I had this down. I've been speaking about this as being still increasing, but it does look as if certainly in Australia that's topping out, and so potentially that's a tailwind that's going to turn neutral and maybe even turn into a headwind if debt starts to flip back the other way.
Absolutely.
And tax reductions though is still heading in the right direction. Right or wrong direction depending on which side of the take you, but certainly still a tailwind for economic growth.
Okay.
And certainly for companies growing their profits. It's certainly a different investment environment than what we've seen, and with each of those tailwinds turning into headwinds or turning neutral, you have to be. Your longer term outlook needs to be certainly more muted than what it was over the last period.
Okay, yeah, sure. And so I guess for practically in an investment standpoint, how's this sort of playing? Are we even just if we just draw on our own setup in the portfolios at the moment? So maybe just major asset classes and how we're sort of reflecting these themes today. In
sure. So there's 4 ways in which I look at how to use these trends in terms of your investment. One is, as you're doing your asset allocation, you need to have a look and say, I really can't take the last 40 or 50 years and just put in, this is what equities will grow at because that's what they've grown at for the last 40, 50 years. And this is what debt will do because that's what's happened for the last 40, 50 years. You need to take that into account and change your numbers and pull back that headline growth. At the moment, we need to expect lower inflation and lower growth. And at some stage, we'll need to think about where does that tax stop being a tailwind for your asset allocation. So chances are you're probably going to be a little bit less equities than you would have had than what your models might tell you should be having.
Yeah, so, sure. Okay.
In terms of the inequality and the debt issues, it means more crises. So again, it's more volatility. If you keep seeing those high debt rates, it makes it a lot harder for central banks to raise interest rates and lower interest rates, because when there's a huge debt burden and you raise interest rates just a little bit, all of a sudden you've put the brakes on the rest of the economy. So it does mean there's more chance of crises if they get them wrong.
Okay.
So not something to panic about right now, but it is certainly expect to see more crises over the next period.
Sorry, go on. Yep. Taxes.
Yep. From taxes. So from a tax perspective, I do expect that at some stage you'll get this backlash in terms of pushing against. We see a bit of it in terms of Facebook and Google, and we've got to set up a Google tax or an Apple tax or whatever, because they keep shifting their taxes around and we can't track them down.
Yep.
Potentially at some stage you will get the point where people say, well, maybe we just can't keep lowering company taxes. That's probably a while away, especially in the US, given they've only just cut taxes.
Yep.
But something to keep in mind. And then the other one is just some of the demographic changes we spoke about, and whether that means selectively is whether you want to be getting into healthcare and retirement services and things like that, rather than problems at the other end.
Yeah, small nappies, kids nappies.
And so it's a question about, but again, it's not none of those are sort of buy and forget.
Yeah.
You look at companies like, and healthcare is a great example of that, where right now, if you want to buy healthcare stocks in emerging markets, for example, to get benefit, get this exposure to these great growing populations and Chinese aging population and increasing wealth and all that type of stuff, they're some of the most expensive healthcare stocks on the planet.
Yep.
So you really have to pay up for it. So the question for me is always, you want to look for these trends, and you find them and you go, yeah, okay, that's an area I'm interested in buying. I'll buy at the right price, but I'm not going to pay 10 times as much as what they were trading at a few years ago, just to get in there. And so it's a question about putting those on your list of stocks you want to buy, and then just waiting for them to get back to the right price where you find it attractive.
Okay, all right, fantastic. All right, well, on that note, we'll finish up. So thanks very much, Damien, and a great little recap there of our mega trends that we're looking at. And we'll jump across to what's coming up next week. So we've heard the trade war, if you were listening last week, has been postponed. So it's now Thursday. Not the trade war itself, the chat about the trade war.
Well, that's right. That seems to be accelerating the trade war. But having said that, I think we spoke about it. We'll hopefully have a little bit more clarity as well next week to talk a bit about it. But there's obviously a lot in play in terms of the trade war and the effects it's having on global stock markets and eventually the actual economies involved.
Absolutely, and there'll be a handful more tweets out, no doubt, as well, that we can have a bit of a read through. So that's on same bat time, same bat channel, Thursday the 23rd of May at 12:30 Australian Eastern Standard Time. Just head over to the Nucleus Wealth live webinar page if you'd like to watch it live, and as James did today, drop in a question and or put up your thoughts. So thanks for that, James. And on that note, well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.